calculate the net present value of the planned purchase of the new machinery using nominal or money terms approach and comment on its financial acceptability. The nominal approach says that we have to use the cash flows which are inflated and use a nominal discount rate to discount these free cash flows. Now in this question here, we have been told that they plan to meet the increased demand for their product by buying new machinery which will cost $5 million. That's the investment. The machinery would last for 4 years, at the end of which it would be replaced. The timing of the project is 4 years. The scrap value of the machinery is expected to be 5% of the initial cost. The depreciation would be available on the cost of machinery on 25% reducing balance basis, with the balancing allowance or charge claimed in the final year of operation. The investment will increase production capacity by 9,000 units per year. That's for the 4 years. And all of these units are expected to be sold as they are produced. Financial info in current price terms, that is without the inflation, is as follows. We've been given selling price, variable cost, and fixed cost with their forecast inflation. In addition to the initial cost, initial investment in working capital of $500,000 will be required. The investment in working capital will be subject to inflation, which is 4.7%. Working capital will not be released at the end of the project. So I just need to invest at T0 and take incremental bits on the working capital here. HCW pays tax on profits at 20% per year, 1 year in arrears. So we need an extra column. The company has a nominal or money terms after tax cost of capital as 12%. So the discount rate is given as 12%. Now to do this, the first thing is we need to get the workings out of the way. So I'm going to do the first working here, which is sales, and we work in dollars. It's a 4-year project, so I'm going to set up the years here. We have the selling price given to us, which is $650. We can just copy this selling price in all these years. But remember, this is not inflated. So we need the inflated selling price here. The inflated selling price by 4%. So we'll take the B3, 1.04. And we will take the B4, again 1.04. Now what you can do here is you can just drag this forward and you will have inflated selling price in all the remaining years. The volume is 9,000 units. I'll just again copy. And finally, I can work out the total sales here, which will be the B4 times B5. And we can just drag this forward and we have all the sales. Now, you shouldn't spend too much time in formatting this working. The only thing I can do here is I can bring it in the middle. And we can just think about these here. And something like this. So there are no additional marks for formatting the answer, and this is enough to show a good presentable answer in your spreadsheet. Now to do the working 2 on the variable cost, what I'm going to do is I'm going to copy this and change things in the same working. That is the beauty of doing these questions on a spreadsheet. So you're just going to say this is working 2. It is our variable cost. The variable costs given are 250. So I'm going to change this 250 here. I'm going to think about the inflated variable cost here. Remember the inflation is 5.5%, 1.055. Going to use the 1.055 here as well, and then we can move this forward, and this gives us the inflated variable cost in all these years. I have the volume and I have the total variable cost here, which is now already calculated. So this completes my two workings here, the sales and the variable cost. The third working which I can do here is the fixed cost, which will be in dollars again. 1, 2, 3, 4. We just need to think about the fixed cost here as the inflation on the fixed cost is 5%. We can directly do the inflated fixed cost here. So we can take the 250,000 and apply the 5% inflation on them. We can take the B17, apply the 5% inflation on it, and then I can just drag this forward and have my fixed costs in all these years. Again, please do not spend too much time on formatting. You can bring things in the middle, and that should be okay on the fixed costs as well. So we've done the first three workings here. Now let's consider what else can we do here in terms of workings. Well, we can do the working capital as well. So we can do working 4 here. The working 4 will be the working capital. Again, I'll put it in dollars. 0, 1, 2, 3, 4. Cumulative working capital and incremental working capital. The investment was $500,000. So we'll take this $500,000 as cumulative working capital. This will increase by 4.7%. So we'll take the B21, 1.047. This will further increase by the same 1.047. So C21, 1.047. And this will keep increasing by the 4.7%. And you can just think of this as a little formatting we can do here on these numbers. The incremental working capital needs to be found here. So first of all, I need to show this as negative minus the B21. That shows the negative $500,000 minus difference between C21 and B21. That gives me the incremental working capital here. And then I just need to continue with the differences in all these years. And that is it. This is my working capital, which is incremental. But remember, this will not be released in the last year. I didn't say that. What else can we do here? We can do a working 5, which thinks about the tax saving on depreciation. Tax saved on depreciation. Now remember, the tax here was in arrears. That means the tax saving will also be in arrears. So we need to think about year 2, 3, 4, 5. I have investment. The total investment which was given here as $5 million. So 5 million is your investment. We have the scrap value, which is 5% of the initial cost. So the scrap value is B32, and we just need to take the 5% of that, giving us $250,000. Now what we need to do here is we need to take the investment, which was the B32. I need to think about the depreciation, which was 25% reducing balance. So take the 25% depreciation and then into the tax rate, which in this question is 20%. And this gives me the tax saving on depreciation in year 2. Now I have a quick way of doing the remaining figures here. We can just take the B26 and we can apply the 75% on it, which is 100 minus the reducing balance percentage. I've got 187,500. I'll do the same again. I'll take the B27 and I'll take the 75% of that. And the final year, remember, will be the balancing figure. But to find that balancing figure here, we need to work out the total tax saving on total depreciation. So let's just think about that. So what is the total depreciation here? It is B32 minus the B33. That gives you total depreciation, and the tax rate is 20%. So that gives me total tax saving on total depreciation. And then what I can do is I can take the B30 minus B26 minus B27 minus B28. And that gives me the balancing figure in the last year. So these are my tax savings on depreciation, which I've worked out in dollars. So we're done with the 5 workings here. And next thing what we can do here is we can bring all these workings in our format and try and do an NPV. Let's just think about that. We can do the NPV in dollars. We can say 0, 1, 2, 3, 4, 5. Now I've already done all my workings above, so what I can do is I can just say, well, I can work out the operating profit. So I can just work out the operating profit here. And for this, what you need to do is you need to take your sales. Just check what was the sales that you calculated. Well, the sales was 6084000, and I'm going to deduct from it the variable costs, which would be in B13, and then I have to deduct the fixed cost as well. So let's just think about this. So my sales are in B6, variable costs are in B13, and the fixed costs are in B17. So what I'll do here is I'll just say, well, I'll take the B6 minus B13 minus the B17. And just check here that you have taken the right things there. Yeah, we've taken the sales, we have taken the variable cost off, and we have taken the fixed cost off. And this gives us the operating profit for the first year. We can just drag this forward, and this will fill up my operating profit in the remaining years, which is up to year 4. I have to think about the tax. The tax is at 20%, but this tax is in arrears. So what I need to do here is I need to take minus C37 and I will apply the 20% on it. And this gives me my tax to be paid in year 2. I'll worry about the formatting later. Just let me get all the figures out here. The next thing is the tax saved on depreciation, which we did in our working above. It's working here, working 5. So working 5. Let me just bring things from there now. So we had B26, we had B27, B28, and B29. So got my tax saving on depreciation there as well. Well, the next thing is that we can think of investment. Remember, the investment here is the B32, negative B32, which is $5 million. I can think about the scrap value, which is in B33, so I can put it here, B33. The final thing is the working capital. And again, we've done that working above for the working capital, which was here. It was the working for, and we had the working capital from B22 to F22. So B22 to F22. C22, D22, E22, and F22. So that's the beauty of the spreadsheet, that we don't need to do all these again and again. We can just do it once and just link it to the cells above. So I can format at this point. So this is what I've got here. Next thing is I can work out the free cash flows. So this is again my memory aid here, the Otis W, and this gives us the free cash flows. So we can work out the free cash flows and say, well, what I need here is the sum. I need the sum of from B37 to B42. And we can just drag this forward and have the sum in all these years. Now what we can do here is we can put our discount rates. So discount factor at 12%. So again, in the exam, you will have access to a formula sheet on your system. So what you can do is you can just take the 12% discount factors. So 12% discount factors, here are the present value table. So 12%, it is 0.893. It is one here, 0.893, 0.797, 0.712, 0.636, and 0.567. Once we've got these discount factors at 12%, we're going to just work out the present values here. And what we can do is we can take the B44 and multiply that with the B45. And drag this forward again to have the present values of all these years. And the final thing is we can take a sum of these present values. NPV is equal to the B46, or we can take the sum here, B46 to G46. And this gives us the NPV here, which can be formatted this way. And I can make a comment here and say, well, NPV is positive, shareholder wealth will rise, therefore accept the project. And this will ensure that I have earned all the marks here. So the key part here is that we need to be good with the calculations and using the spreadsheet, but please do not waste too much time on the formatting. You can just do a final little formatting on the workings that you've got, and this should be enough. So here is our overall NPV that we've got here on this question.